Hi. We're going to start a discussion of bonds, and I hope you'll be following along in the class notes on bond basics. I'm going to be pulling them up in just a little bit to start talking about that and referring to some of the things that are there in bonds. First of all, a bond is simply a loan. It's an IOU. Somebody has borrowed money from somebody else. Whoever owns the bond has lent out some money. Whoever issued the bond, well, they have borrowed some money. And the bond is a promise to make specified payments to the bondholder from the bond issuer. The a few terms that we need to be aware of is, first of all, the term maturity. Bonds have a maturity, not like stocks. Stocks have no maturity. They will go on forever. But a bond does have a maturity. It's a day at which the loan is paid off. Hopefully, if you borrow money, you're going to pay it off at some point in time, and that is the maturity on the bond. The face value is, I think, a way to look at it. It's not entirely correct, but one way of looking at it is that is how much money is borrowed. But actually, it's a large single sum payment that is made at maturity. It is going to be separate from any interest payments. Coupon rate is an annual percentage. It's the interest rate on the money that is borrowed, and it tells you how much the semi-annual coupon payments are going to be. So a coupon rate is going to be an annual number, but the coupon payments are going to be made semi-annually. Let me give you an example with this by pulling up our class notes where I think you'll be able to see this well. Here is a bond right here. Okay, let's see. Let me see if this is going to work for me. Okay, so here's a bond right there, and this particular bond, that's the timeline on the bottom, and these are the cash flows on the top. So you can see this is a 10-year treasury note, so the bond matures in 10 years. But all the bonds that we're going to be looking at that make coupon payments make their coupon payments semi-annually, once every 6 months. So this first coupon payment at time 1 is going to be after 6 months. Time 0 is right now. Time 1 is in 6 months. Time 2 is in 1 year. Time 3 is in 18 months. 4 is in 2 years, etc. So time 20 is in 10 years. Now, this particular bond has a $10,000 face value. That means at maturity, the bondholder will receive $10,000. The coupon rate is 7%. That means the bondholder will each year receive in coupon payments, which are the same. Coupon payments, interest payments are the same thing. So the bondholder will receive coupon payments equal to 7% of the face value. If the face value is $10,000, then the bondholder will receive 7% of that each year, which is $700. But they're receiving the coupon payments semi-annually. So half of $700 is $350. So every 6 months for the next 10 years, the bondholder will be receiving $350. Plus, the bondholder will receive $10,000, the face value, when the bond matures. So when you see this $10,350 here at maturity, the $350 is the last coupon payment. The $10,000 is the face value that they're getting there. Well, who will issue bonds? Well, bonds can be issued by a number of different entities. As you've probably heard, the U.S. government spends more than it brings in taxes every year. So the U.S. government needs to issue bonds to be able to raise the rest of the money. And as we said, a bond is an IOU, it's a loan. So whoever owns a treasury bond is lending money to the U.S. government. You may have heard also the term treasury note and treasury bill. They're all really the same thing. A treasury bill is when you're lending money to the U.S. government and it's going to be paid back in 1 year or less. A treasury bill has 1 year or less to maturity at the time it's issued. Treasury note has more than 1 year, up to 10 years, and a treasury bond has more than 10 years. The longest treasury, really the only treasury bonds that are out there right now are 30-year treasury bonds. So we'll tend to use those terms interchangeably: treasury bill, treasury note, treasury bond. but they do have a difference. Treasury bills in particular are different. We will probably not use that interchangeably, but Treasury notes and Treasury bonds, we probably will. And the reason why on the Treasury bills are so different is they don't have coupon payments, but we'll get into that later. Right now, we're dealing with Treasury notes and Treasury bonds, which do have coupon payments to them. Okay, so what is a bond worth? Well, it's going to be worth the present value of the future cash flows. So you learned in your first finance class how to calculate present value. We're going to be doing that with bonds. So at any point in time, we're going to say the value of a bond, what it is worth, is the present value of the future cash flows, discounted back at the bond's yield. We'll talk a little bit more about what the yield of a bond is, but that's the discount rate for a bond. So let's take a fairly simple example here, and let's suppose that this particular bond, okay, that you are standing here right at time zero, and you buy this bond, and you are entitled to receive all of these $350 payments and the $10,000 face value at maturity. What is the value of the bond? Well, let's go into Excel to calculate that. So we're going to bring up an Excel spreadsheet here. And what we're going to do to calculate the price of the bond is the present value of the future cash flows. So we're going to say equals, I'll put in here equals PV for present value. We're going to put in the left parenthesis, left bracket, go to the function wizard. And what we put in for rate is going to be the yield on the bond. Specifically, it's going to be the semi-annual yield. Now, the yield on a bond, for our purposes right now, you can think of this as what are interest rates in the economy. They change all the time, right? Interest rates last year are not necessarily the same as interest rates today. Interest rates a year from now may be different. So the rate we put in here is always going to be where are interest rates currently in the economy. Technically, it's the yield on the bond. For right now, those are pretty much the same thing. But it needs to be a semi-annual number because bonds always do the coupon payments semi-annually. So let's suppose right now interest rates are at 7%, right? And we will generally assume that when bonds are initially issued, their coupon rate is set to be equal to where interest rates are in the economy. That's not strictly true all the time, but it's close enough that it'll work for what we're doing. So we're going to put up here that the rate, the semi-annual rate, is going to be 0.07 divided by 2, okay? 0.0, because 7% is the annual rate, divided by 2, we get the semi-annual rate. The number of periods, NPER is the number of periods. This is the number of compounding periods. This is how many times we're going to be receiving the coupon payments. And with this particular bond, it's going to be for the next 10 years. It's a 10-year treasury note. So we could type 2 times 10. That would be fine. I'm just going to type in 20. There are 20 semi-annual periods where we're going to be receiving this. The PMT stands for payment, and this is going to be how much money you're receiving in each of those 20 semi-annual coupon payments. Now, remember we said the coupon rate on this bond was 7%. 7% of the face value, $10,000, is $700. So each year we're going to get $350. I'm sorry, each year we're going to get $700. Each semi-annual period we're going to get $350. So we're going to put $350 there because that's how much we get every semi-annual period. The face value can also stand for future value. That is going to be what you receive when the bond matures, which is going to be $10,000. Now, it's important that the payment, the coupon payment, and the face value are the same sign. They can both be positive or they can both be negative, but you can't make one of them positive and one of them negative. Because if you own the bond, you're receiving both the coupon payment and the face value. So they've got to have the same sign. If you have issued the bond, you've borrowed the money and you've issued the bond, you're going to be paying out the coupon payment and the face value. So no matter which side of the transaction you're on, the coupon payment and the face value are going in the same, our cash flows going in the same directions. They have to be the same sign. Type we leave blank because the first coupon payment is coming one semi-annual period from now. We click on OK, and we get an answer of $10,000. And of course, I think you know it's a negative, simply meaning that if you are buying the bond, that is a cash outflow to you to pay the $10,000. And then you will be receiving the $350 coupon payments as a cash inflow, as well as the $10,000 face value as a cash inflow. So they were put in as positive numbers, indicating you're going to be receiving that money. And Excel tells you, okay, you're going to be spending $10,000 when you buy the bond. That's cash outflow. All right, well, that sounds great, that the value of the bond is $10,000. What happens if we hold this bond for 2 years and we receive 4 semi-annual coupon payments during that period of time? So 4 different times, we're going to be receiving $350. On that timeline you looked at on the notes, it's going to be just past the 4th number where you've just received your 4th semi-annual period, and you want to sell the bond. Okay, so you want to know, how much is it worth? Well, again, it's worth the present value of the future cash flows. So the remaining cash flows are still $350 right here. That's going to be every 6 months, and $10,000 that you're going to get at maturity. And let's suppose interest rates in the economy are still 7%. So the semi-annual rate, or the semi-annual yield, is still going to be 7% divided by 2. But now you've already received 4 of the payments. So the remaining payments are no longer 20. The remaining payments are 16. So we're going to take away the 20, put in 16, and say, now what is the value of the bond? And it's still $10,000. And so here's a basic principle. Anytime the yield on the bond or interest rates in the economy are equal to the coupon rate, the bond's price will be equal to its face value. Okay, so this 7% right there, okay, that is up there not because it's the coupon rate. It's there because that is the yield on the bond, which is the same thing as interest rates in the economy. So when interest rates in the economy, when the yield on the bond happens to be equal to the coupon rate, then the price of the bond, which is what Excel calculated for us, will be equal to the face value of the bond. And it doesn't matter how many time periods you've got left. If we have only 10 time periods left, that's going to be true. So no matter what number we put up there, it's going to be true. So let's go back to where we've got 16 semi-annual periods left. And let's suppose that between time 0 and time 4, interest rates haven't stayed at, have not just stayed at 7%. Suppose that interest rates have gone down during that period of time. Interest rates have gone down to 5%. What we want to do now is we want to change this rate from 7% divided by 2 to 5% divided by 2. So that's where interest rates are in the economy, 5%. We would also say that is the yield on the bond. We have 16 payments left, $350 each on those coupon payments, and then we receive the $10,000. What's going to be the value of the bond? It's going to be $11,305. The price of the bond went up after because interest rates went down. Suppose interest rates had gone up during those 2 years. So again, we've got 16 semi-annual periods left, and interest rates have gone up from 7% to 9%. Enter that in, and you'll see the price of the bond is $8,876. Interest rates have gone up, and the price of the bond has gone down. So here's a very important principle that we'll be coming back to again and again on bonds, that whenever interest rates go up, the price of a bond goes down. Whenever interest rates go down, the price of a bond goes up. The bond's yield and its price, which is what interest rates are, the bond's yield and its price move in opposite directions. We can see why this is mathematically if we take a look back at our notes here. So let's go back to our class notes. And when we see the formula, the math formula for a bond, we see that the price of the bond is going to be equal to the coupon payments of $350 times 1 over R, where R is going to be the semi-annual yield, minus 1 over R times 1 plus R to the T. T is the number of semi-annual periods that are remaining, plus the present value of the face value, which is the $10,000 in this case, divided by 1 plus R, semi-annual yield raised to the T power. So what you see is if the yield, okay, which is R, goes up, that's in the denominator, so the price has to go down, right? Anything in the denominator goes up, the solution, the answer has got to go down. If the yield goes down, the price has got to go up. So mathematically, that kind of makes sense. Intuitively, why that's the case is because bond issuers are always issuing new bonds. The US government, for example, the Treasury is always issuing new bonds. If interest rates go up, the new bonds are being issued at a higher coupon rate. And so if interest rates go up, then the value of your bond is going to be going down because your bond is paying a lower coupon rate than what new bonds are being issued at. If interest rates go down, your bond is still paying the same coupon rate it was when it was issued, which is higher than these new bonds coupon payments are going to be. And as a result, your bond having a higher coupon payment is going to be able to sell at a higher rate, what we call selling it at a selling it at a premium. Now, speaking of selling at a premium, when bonds prices are above their face value, then we would say they are selling at a premium. If the bond's price is above its face value, it's selling at a premium. If the bond's price is selling below its face value, we say it's selling at a discount. And when a bond's price happens to be selling exactly at the face value, we say it is selling at par. Normally, just to make matters a little bit simpler for us, because face values can be anything, they can be, as in this example, $10,000, they can be $1,000, they can be $1 million, they can be $500,000, whatever, okay? We typically express a bond's price as a percentage of its face value. So in the example that we gave right here, okay, going back up to the first page, the bond's price was $10,000 and the face value was $10,000. So its price was 100% of its face value. When we talk about the price of a bond where its price is 100% of the face value, I already told you it means it's selling at par, but bond dealers and others will typically say that bond is selling at 100. Now, this will make life a lot easier for us. It's as though the face value of the bond was just a nice 100, where we don't need to worry about what it is. If a bond's price is quoted at 100, it means the price is 100% of the face value. If the bond's face value is $1 million, then the bond's price is also $1 million. If the bond's face value is $500,000, the bond's price is $500,000 when someone says the bond is priced at 100. It doesn't mean the price of the bond is $100. It means the price of the bond is 100% of its face value. So a bond whose price is 102, it means it is selling for 102% of its face value, which means it's selling at a premium. A bond that is selling at 98, it's selling for 98% of its face value. We would say that bond is selling at a discount. So that's the first basics about calculating the price of a bond and understanding how we quote the prices in Excel. In our next video, we'll start talking about the yield and how to calculate the yield to maturity for a bond.